Hey friends, welcome to another episode of Navigating the Markets for this holiday shortened week that's starting Tuesday, January 16th. First, let's look at what happened last week. Natural gas was a big winner. It's unusual this time of year. Typically, it's a loser based on the seasonality going back to 2009, but we are seeing a big bid here. Some of this is short covering. We are still well above the 5-year storage range, which suggests that there is still ample supply, although we are dealing with a pretty big cold snap and a lot of unusually cold weather, which is probably starting to have an effect on that supply, but also boosting rates because it's hard to deliver all of that at the same time when it might be needed. So it is interesting to look at what's happening in natural gas and contextualize it as not what you typically see in January. Often is the case, it's down for the month by about 5%. On the other side of the trade, you have volatility, platinum, palladium, all losers last week, although platinum may be setting up for a swing long based on the current price action. In this look below, we got to see if we're able to get above 925 in the week ahead to really set off that long signal here. The Nikkei was also a leader last week, up 6.34%. And this is a sign that Japan just continues to move. And I think part of this has to do with the fact the markets realizing the Bank of Japan is not going to head into zero interest rate policy as early as it had expected. I know some folks were looking for that at last year's meeting. Others were looking at it in the next two meetings from BOJ. Aisha has a view on this that it's probably more of a second quarter to third quarter theme. And I agree with that based on Japan's economy being as weak as it is. We will get some inflation data out from the country during the week ahead that will also be quite important. And the heat map from last week, looking across the market, was very strong in the mega caps and the semis and software, not so much in some of the other areas like financials and energy. Defensives did hang in there, as did some of the other areas like healthcare and industrials. I think this is a market that is continuing to sort of figure out what sort of positions that players want to put on as we get into the year ahead. I still favor some of the trades that we've talked about earlier, like value versus growth, equal weight versus market cap, as long short positions. I also think value versus growth in emerging markets is interesting. That's a market where a lot of folks are getting involved because of the relative value there. So looking at value as a factor is likely to be a place where you see a lot of that institutional money in those EMs. And indeed, value has been outperforming growth in emerging markets over the last several years. So that's a good pair trade to consider moving forward: long value, short growth, and equal size. And with all these pair trades, I like to rebalance to be equal size in dollars at the end of the week on Friday or on Monday, whatever works best for you, so that way one side of the trade doesn't get too lopsided. Now, looking at NASDAQ 20-day over moving average stocks, this percentage is now down to just 39.07%. It was as high as 71.22% earlier. That was exhaustively high. That's a very bullish reading, but it's bullish in the sense that all those bullish views have already been expressed and those outcomes have been experienced. And typically when you see that big of a thrust, it leads us to some degree of exhaustion and then some corrective repricing. And we're seeing that now. We're almost halfway down back from that high of 71.22. And this tells us that we're no longer in really overbought extreme greed territory. We're now sort of neutral in terms of what we see from this very high frequency indicator. The next one I'd like to point your attention to is the NASDAQ McClellan oscillator. This is one that I like to look at for momentum and breadth, and we can see it is rolling over here. We are not oversold by any stretch. You can see the green line is what marks that, just like the red line marks overbought, and that's under minus 70. Occasions where the market goes under minus 70 are often decent areas to start looking for a reversal and a buying opportunity. And we have not seen that yet. Really, we haven't seen that since March of this year. Not even October and really the fall selling set that kind of an indicator into motion this time around. But on the other side of it, we did get an exhaustive print in November that set off a lot of that breadth expansion. That was not the sell signal, but it was a warning sign that things were getting a little ahead of themselves. And so this reversal And where it goes from here will be important. If we do see that seller exhaustion signal, it'll be important to look for the potential breakdown in prices that indicates the opportunity to take profits and enter short positions potentially. Now, when we look at NASDAQ new highs versus new lows, this is telling us last week was a much more constructive week than the week prior, whereas we did see a bid come back 54 new highs versus new lows on a net basis in the composite last week. That is the best reading that we've had in 3 weeks. So that's exactly what we do want to see. But now we want to see whether that builds. So far, it's been a little bit hit or miss. As we've seen, breadth has been kind of weak in the NASDAQ. If this is able to build and we're able to see momentum move higher for the larger amount of stocks in the index, that'll be helpful because they really did not have a particularly great last 2 years. As you can see on this chart, a normal bull market, the more area with black bars on the left, that was 2021. That was when there was a lot of upside participation in the NASDAQ. We simply haven't seen that in the last 2 years. And in the last year, the upside has been driven by this handful of very large weights in the NASDAQ 100 and NASDAQ composite. And that's really helped to lead the S&P higher as well. But that hasn't led to the kind of participation you typically see in a bull market where equal weight and small caps lead because risk appetite is wide and very healthy. Now, when we look at our proprietary NASDAQ Momentum oscillator, this is starting to give us a little bit of a heads up. It's not yet telling us that it's time to get out of the swings in the NASDAQ that were set off in early November as longs, but it is telling us it's time to be cautious because this is consolidating here. If we see the purple or the blue lines cross below those orange bars, that is going to tell us that it is an exit, sort of like what we saw going into August from that July rally. You see that cross below, that was time to get out, just like November's cross above was time to get in. This has been a great indicator. You can find it on the Traderade website. It's under the members section. Highly recommend checking in on it at least once a week to get a sense as to where the momentum is, because this thing has been eerily accurate for a lot of the great swing trades that one could express in the NASDAQ, in the S&P, or some of the leading stocks. Now, speaking of sentiment here, because it did get really, really blown out, we have retraced higher. We're at about twice as many bulls to bears in the AA bull to bear indicator. This is a survey where they ask participants who are largely retail, where do you see the stock market in 6 months? Are you bullish or bearish? And right now you've got twice as many people saying I'm bullish in 6 months than bearish. This isn't exhaustive, okay? The exhaustive to me is really the times where we get to 2.5 or higher, but it is very bullish. So it is a sign that sentiment is, people are already very much thinking about and positioned for upside. When we look at NAAIM, this is institutional money. They have added last week to their longs. They did sell the first week of the year. Last week, they added to their longs, getting to a net basis of 80.18. This is the highest level that we've seen in 2 weeks when it was over 102. Now, this is by no means an exhaustive reading. Sort of like AA, this is just telling us, okay, they're really positioned for upside. They're not exhaustively positioned where there's no one left to buy, but they're not scared. They're not really hedging. We can see that in skew. We can see that in short interest in a lot of areas. The only areas that are very aggressively shorted or hedged are some of these single stocks and macro products like IWM. But when you look at the broader picture, when you look at skew in the S&P, which is sort of the center of the hedging universe, and when you look at futures positioning of non-dealers and otherwise, it's all very much indicative of a poorly hedged market. Now, when we look at these leading sectors, this is transports on top, followed by semis, home builders, and durables. We can see there is strength throughout. Transports are a little bit weaker, but semis, home builders, and durables are all breaking out. And that is the market voting for strength in the economy. That is the market saying, we are looking for more expansion from the consumer, from global trade. And this is a pretty big vote of confidence. And this is one of those things we can't ignore because the market is attempting to look forward and trying to price in what it thinks is going to happen. This is also, though, the same market that's looking for 6 rate cuts this year. And it would be interesting to see an economy with this type of optimism where everyone's bidding these cyclicals, these leading cyclicals, at the same time and it's an economy that needs 6 rate cuts because things have gotten that bad somehow. So one of these two things does not align. This picture suggests a soft landing. The 6 rate cuts that's being priced in suggest a hard landing. So it's going to be really interesting to monitor which narrative plays out. Is it going to be the one in the rates market, or is it going to be the one in the equities market? Because the two markets do not agree, particularly on the very short end of the rates market and what we're seeing in twos and what we're seeing in SOFR, and then what we're seeing priced in equities. These are completely divergent outcomes that are being priced in, and it's very interesting to kind of look at the contrast between the two. Obviously, if we have a soft landing, the Fed doesn't need to cut 6 times, but if we have a hard landing, it does, and this is mispricing economic growth with a hard landing. So we'll have to see how it all comes together. We'll continue to track this at Traderade and the opportunities to trade against it or with it that come through. Now we're going to look at vol versus vol of vol. The purple line is the VIX. The black line is the volatility of the VIX. And when vol of vol gets bid, it's typically a sign that people are looking for VIX calls. And there was a very large VIX call play. We'll look at that on the next slide that did come through that pushed VVIX higher. Now, this does not mean that the VIX has to move higher. What it means is that the market is growing more positioned in aggregate for the VIX to move higher. Market's not always right about what happens with the VIX, but it often does have a good sense. So this next chart shows VIX calls bet on volatility pickup. An investor snapped up 250,000 VIX contracts expiring in February for 17, quite a ways higher than where we are in the VIX now. And so that is one of the things that pushed up the VVIX, right? Because the volatility of the VIX is going to increase when you have skew towards VIX calls, and those VIX calls are being bought in size, right? So you have that volatility, the value of the premium and the VIX increasing with that boosts up the vol of vol. So we need to be attentive to what's happening with volatility, because the times of subdued vol may be somewhat tenuous in terms of how long that can last. And while vol is still pretty well supplied, I would suggest that as we get past Opex, and we look to people, luminaries in this space like Jem Carson, who follows it pretty darn closely, there is a heightened risk that we could start to see more risk off. That passive flow that will likely buffer the markets in the week ahead will not be as prevalent, right? So this week that we're coming into is options expiration week. It's also VIXpiration. So the VIX expires on Wednesday. That tends to add to the vol that we see in the markets, more, choppy trade, more downside risk. And then we have the greater options roll off on Friday with index and single stocks and ETF options. And that is likely to then unhinge us or unclench us from gamma and bring us to a new week where we could have greater volatility. I think that'll be very important to pay attention to. And if indeed this trader is correct, they're looking for a pretty big surge in VIX. Now, I don't know if this is a directional bet or if this is a hedge. It could very well be a hedge for a lot of long exposure for a portfolio that wasn't very well hedged. So maybe in that case, it ends up helping them not have to de-risk into a downside event. But whatever the case may be, we are seeing the market expressing more interest in upside in the VIX. Now, of course, that does have the other effect of reducing the potential of the VIX moving terribly higher if there's that much exposure overhead, but at least a trip to 16 or 17 on an increase of vol from some distribution in the markets is something we want to look for, not this week, but in the 2 to 3 weeks that follow. And as we go into the week ahead, 4,800 is a very important level to watch on SPX, or the S&P 500 cash index. That is the largest area of both gross and net gamma positioning, and it has been an area of resistance that I expect could continue to be an area of resistance. That being said, as we get into the week ahead, as we were talking about, we have those passive decay flows from dealers, basically covering shorts in the S&P as the puts that have been bought as hedges lose value. And that adds to the bid in the market. That bid is expressed in S&P futures, and that adds that kind of upside bias in the beginning and end of trading day hours, right? Like from 9:30 to 10:30 and 3 to 4 especially, you see a lot of that removal of hedging accelerate. And so that's one of the reasons that you can't come into this week with too much of a bias in any way. It's Opex week. You have an odder distribution of probabilities that are less aligned with what we're used to. You have a lot of the passive flows increasing, but it's going to be a bit of a war between the S&P passive flows and then the single stock and ETF flows, which are going the opposite way. There's put skew on the S&P. It's not extremely pronounced, but there's a lot of call skew on index ETFs and especially single stocks, where that decay means dealers are removing long positions in those underlying ETFs and stocks, and that's causing some distribution. That's causing some downside pressure. So there'll be a bit of a convergence of these things. Obviously, the index options, the S&P is the biggest part of this, so the bid from that is substantial. But we still have to take into consideration those other offsetting flows in some of the more popular stocks like the mega caps, triple Q, IWM. That skew is all very much closer to call skew than it is to put skew. Now, when we look at U.S. core CPI from last week's macro data extravaganza, we have seen a deceleration here. It is maybe stabilizing a little bit. It may not quite get to the Fed's target as quickly as hoped. And we have seen some Fed speakers like Williams from the New York Fed pushing back on the idea of the imminency of rate cuts and the progress that's been made on inflation. Now, the week ahead, we've got a whole litany of Fed speakers again. I know you all love Fed speakers as much as I do. It'll be great. We can hang on to every word with bated breath and see how it moves the markets. But in all seriousness, there is likely to be some conjecture about where we are in this whole narrative of shifting towards easing and winning the battle against inflation. Not everyone is agreeing that the war has been won or what the next path is. The Dallas Fed, she said last week that they may need to taper the balance sheet and keep rates higher for longer because of some of the things that are happening with reserves and what we're seeing with overnight funding stress. So it'll be interesting to see what sort of narrative is taking shape as we approach that January meeting, full well knowing that the market's still pricing in 6 cuts this year. Now, when we look at PPI, we got that on Friday last week. It came in quite low year over year, a little bit of firming up, but really this is, you would annualize this well below 2%. There's typically about a 2 or 3 month lead time for PPI to translate to CPI, but this would at least suggest that there could still be some downside pressure, some disinflationary pressure in CPI. And then there's this. This is the Drewry Shipping Composite Index. It is up 50% year over year. This has everything to do with the tensions of the Red Sea that have helped to drive stocks like Zim higher. It's one of our short squeeze trades that's almost doubled since when we started looking at that stock as an opportunity. And this is one of the reasons why, because it's becoming more profitable to move goods. And that profitability has everything to do with the perception of risk to move goods. And that risk has increased materially because there's this tension due to the Israel-Hamas conflict. These Iranian-backed Houthi rebels are attacking various ships in the Red Sea, and those tensions are creating this premium. And as long as that premium exists, the shipping companies that are able to charge those higher prices and deliver on them are going to benefit, and that's created some of this catalyst for this squeeze that we identified first because of the flows, and then we started to see some of the further catalysts become more of a prevalent component of price discovery. Now, IT spending this year is expected to grow. This is one of the reasons where there could be a resilient bid in some of the key players in hardware, looking at places like Palo Alto, Qualys. These are names we've identified in the past. Juniper was one we talked about. They got bought out by HP Enterprise. but that name has traded a premium since we talked about it on our Thesis Thursday talk. And Qualys has done quite well as well, and it has everything to do with this increased need for IT. Not all of the spending increases because of nominal, price increases or inflation. Some of this is budget increasing because there is a need to refresh hardware, software, to realize increased productivity, to improve services, to also improve resilience. So software and services spend in some cases hardware like firewall spend can be related to improving cybersecurity posture as well. These are all things that we believe are likely to continue in the year ahead and could play a role in some of the mid-cap growth names that are better run having outperformance versus the NASDAQ. And when we look at some of the key events this week, Wednesday brings us retail sales, Thursday building permits, Friday Michigan consumer sentiment. I think retail sales are going to be the most important number this week, quite frankly, because it's all about December shopping season. Then we've got a 20-year bond auction that's coming up on Wednesday, and Thursday 10-year tips auction. Between the two, $31 billion on offer from the Treasury. I think the 20-year auction will be important for TLT. I know folks have been looking at that and trying to discern where it's going to go from the charts. This auction should give us a better idea as to what the demand is for that longer duration U.S. sovereign debt. And then earnings really kicks up into full gear tomorrow. We've got Goldman Sachs, Morgan Stanley, PNC. Those are going to be pretty important for the financial space. We also have Taiwan Semi, which will set the tone for what's happening in semiconductors. I think all of these are going to be pretty interesting. We also have Kinder Morgan in the energy space and Alcoa in materials. And moving ahead to earnings season, there is some idea that fourth quarter earnings might be a little bit underestimated by the street, and that could set us up for some beats. So we are going to be looking at quarter four, year over year. The projection is earnings shrank based on the consensus, removing financials and utilities. That may not be the case. We actually may have more constructive earnings, and that may lead us to some cases where beats are rewarded. This also sets the bar rather low so that even if you come in where you were last year at fourth quarter, you could be beating even with shrinking earnings, right? So that net profit margin is expected to shrink. We're not so sure that's going to be the case. It may not be quite as bad, but I will color that with one big caveat. During a period of disinflation, which we are very much in, some companies are going to have weaker margins. The next one we have on screen here is crude. Crude, I still am bullish on. The price action we got on Friday was very disappointing. I was hoping we would close out with that move continuing above 73. We didn't get it. I'm still constructive here because we've still made a series of higher lows. We still have RSI twisting and turning higher. We're above the point of control. So I'm still looking for a move up to 85, but I'm guarding my risk. I will stop out with a close below the 20-day moving average. The next one we have on screen is sugar futures. I think sugar is ready for a run. The trend still remains intact here. So I would be looking to add exposure here and managing my risk with this trend line. I know it's very tight, but that's where I'd stop out. A close below this trend line would have me no longer interested in sugar. If it builds from here, I'd be exiting at the prior high. So I know the price got cut off from the chart. I apologize about that. But if you look at the last high, whether you're looking at the cane ETF or sugar futures, that's where I'd be looking at exiting this trade if we do get that rebid, if we continue to see that strength build up. And I would only put this trade on for about 2 or 3 months. After that, I would take it off even if it wasn't below that trend line. And you're going to have to keep updating that. So draw your own trend line on your chart, guard your risk as you see fit. As we break above the 20, I would move my stop to being just below the 20 on a closing basis so that I could guard my risk with more profit on my side. And then the next one we have here is OJ. This one is back in the buy zone, and it's back reverting to this key trend line. I'd be looking at taking a long here. There's no great ETF to play this. This is more something you've got to trade in the futures market if you like really illiquid stuff that can rip your face off. So obviously small position sizes because you have to have a wider stop in OJ. My stop would be below the trend line on a closing basis here. And we have a short idea with PI. I love the symbol, PI, PI, but this stock is breaking down. It's below all its key moving averages. I would guard my risk with a stop on a close above the 200-day moving average. Otherwise, I'm looking for this thing to get back to 61 bucks and I would cover. That's PI. The next one here is OGS. This is utility. And I'm looking for it to get back to about probably about $58 a share. Nice even number would be the initial target for the core, and then $56 a share for runners. A little bit more of aggressive target. This is not a super exciting one. It doesn't move a lot. I would stop out with a close above the 50. I'd probably play this with a put option rather than a short on the shares. So I'd probably have, 2 puts at the 58 strike and 1 put at 56. And I'd be looking for those puts out in March. So let me know what you think about all these. If you have any questions, thank you for tuning in to this episode of Navigating the Markets. Of course, I appreciate each and every one of you from the Traderade community being a part of this awesome and growing community. If you have questions, put them in the comments or ask me on Discord in the questions room and just tag me in. Next time, this is Markets and Mayhem with Navigating the Markets.